Hello, everyone. Welcome to the final bar on this Friday, October 4th, 2019. This is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. A follow-through update today. First time since we've started the show this week to see that. Traditional offense leading on the way up, potentially clearing the way to further recovery next week. Or is this a bounce that we want to start to unwind? We'll talk about that and a lot more today. This is the final bar. Hello, everyone. Welcome back. This is Dave Keller from StockCharts.com on the very special first Friday broadcast for the final bar. Thanks again for joining us. A number of you have joined us every day this week, and I hope we continue this journey together for many, many weeks going forward. You know, the goal with this show, as we envisioned it, was to, step back after the close, take a look at what's happened, and try as best as we could to connect it to the long-term picture. Most of us listening are, do things tactically, do things short-term, but in the end, I know many of us are long-term oriented. And so the goal here is to have a proper perspective and make sure we don't get too caught up in the short-term movements, but instead understand the long-term ramifications of some of the short-term moves. So today, what we were thinking for Fridays is what we'll do is feature a Wrap the Week segment, which we'll get to later in the show, where we sort of really take a step back deliberately and look at some of the long-term indicators and make sure we have a sense of where things are. What I wanted to do real quick is go through some of the market movements that we've seen today, just sort of unpack the action and then continue on. Here we go, sharing the screen. So, Dow, the NASDAQ up 138 here and almost at the close. The S&P is as well. Looking at some of the major indexes, Russell 1000 up about the same amount. Notably here, the small caps toward the bottom and mid caps even further down. So, you have the situation we've seen a while now where the largest companies, the biggest names are the ones that are driving things. And while that's fine, while things can go up in plenty, for quite a while with that configuration, it's not sort of the traditional look you would expect, right? You would expect some of the smaller, more speculative names to be bubbling up to the top of the list. You would not expect the S&P 600, the Russell 2000 down here toward the bottom. So a little unusual compared to what we may have wanted to see. What's interesting, though, is if you look at the sector breakdowns just today, again, on a follow-through day, we had the sell-off into the middle of the week, the rally yesterday, and then this continuation today. Financials leading the way, technology, healthcare. These are kind of the traditional offense groups you might expect to see at the top of the list if things are doing pretty well. One notable miss, can you think of what sector's not there in the top three that you would maybe expect to see if things are all rosy? And that's consumer discretionary, which is down here almost toward the bottom with the MEI trade, materials, energy, and industrial. So we have this flip where while some sectors looking good, financial signaling that things are doing okay, you have staples outperforming consumer discretionary. We're going to look at that long-term view in a little later to sort of understand that. But, so again, it's certainly not by any means an all clear. And I think as we look at take a step back and look at some of the movements, we'll understand why that's we're still sort of in the wilderness a little bit there. Financials in terms of the industry groups, breaking down those, you have broker dealers and insurance toward the top. Semiconductors, actually, we've talked about before, and just as a preview, probably going to be one of the 3 and 3 charts today is the relative performance of semiconductors, because that's often a leading tell for the market. When they do well, the market's tending to do pretty well. And then oil services continues to be toward the bottom on a day when most everything was up. Energy, especially the oil services ETF, down 1%. So not exactly the look you want to see for energy. Looking at a daily chart of the S&P 500, we're going to get later to the weekly chart to make sure we have a proper long-term context. But let's just think about what happened today and how that compares to the overall trend we've seen so far. So here's today, following through on the upside, breaking back above resistance. We identified this resistance level just below 2940. That was the peak from the congestion area here in August. Also lined up pretty well from the highs in May. but we've just now closed above that, also back above the 50-day moving average. So this is much more volatility than we've seen certainly in quite a while. We looked at the VIX yesterday as one of the 3 and 3 charts, certainly elevated, and this is what the daily chart certainly feels to be the case. It lines up very well with what we saw with the VIX. So the question now going into the weekend and really going into next week is what next, right? There are so many potential catalysts that could push the price much further. There are so many potential catalysts that could push the price much lower. And I would hesitate, as always, I've talked a little bit about the news flow and what is causing some of these movements. But I think the point of this show, and really the point of when you're using StockCharts.com, is to get away from the headline risk, get away from the news and what's causing some of these movements, and just focus on the evidence, focus on the data, focus on what is actually happening. Because a lot of times what I've found in the industry is that the reasons why something looks a certain way tends to be very clear in the rearview mirror. It's very hard to come up with a clear idea of what's going to happen based purely on a catalyst, on a news event. The reasons why things evolve a certain way tends to come clear later. So where are we at right now? In my opinion, we had a good sell-off to a very expected demand area, an area where you'd expect buyers to come in. That certainly happened yesterday as we closed above. This is that bullish piercing line pattern we talked about. And then today, certainly getting the upside follow through and falling in there. So the question now is, at some point we pull back a little bit, and where do we pull back to? Do we continue another leg down, and this is a lower high into a lower low? And at that case, you have to again focus in on the support range around 28.40 to 28.60. That would be the level that would be in play. Or do we see an upside follow through? Do we start to continue these to address those levels up toward the top in the 29.80 to 30.20 range? Gun to my head, what am I seeing? For me, I'm seeing plenty of cautionary signals from individual stocks, also from breadth indicators that would tell me limited upside. So you wouldn't expect a ton of upside based on those patterns and the risk of potential downside. So it's all about identifying the key support levels and sort of making sure we're prepared for them. Let's look at how the day actually played out today. And if you look, this is just a 3-day, 5-minute chart. And, again, I'm not super short-term oriented, but this is the chart that I tend to bring up. And you can see how, the last 3 days have been this rotation from a distributive day on Wednesday, the rally Thursday closing at the highs, and then a total follow-through day today on Friday. Going into the weekend, going into Monday, the question is going to be, where are we at relative to some of these levels? And if we do pull back, I would certainly be looking at the levels from Thursday, which was, where buyers came in before. And again, the market doesn't always repeat itself, but it rhymes, right? It has a memory. So looking for those sort of patterns can be pretty instructive. So that's a quick recap of the action. And again, at a big picture level, the S&P looks okay. And certainly the action today and yesterday, pretty positive. But, overall, what we're going to get into as we talk later about wrapping the week is just sort of identifying some of the warning signals and seeing where things are playing out. So we'll get to that in a bit. With the next segment here, yesterday we had Greg Schnell talking about using technical indicators, overlaying them on each other, and sort of the value of looking at different points of view, and got some great feedback on that style of thinking, just trying to help you use the toolkit better, use the technical toolkit better. So what we wanted to do is just break down a particular indicator, in this case, the MACD indicator. And what I'll do with a short time here today is just help you define it. We're going to talk about what it is and then how it works, how you would use it in a trading situation. Then we'll just look at some examples and help you understand how to apply it, how it relates to other things. So if you're not familiar, MACD, the moving average convergence divergence, was created by this gentleman, Gerald Apple, a number of years ago. And it's essentially based on exponential moving averages. So you smooth out the price movements over time. Here we're looking at simple moving averages. These are a little different. Exponential averages just weights the data a little different, easier to calculate, to be honest, in some ways other than others. And essentially what you do is this black line right here is called the MACD line. And that's essentially the difference between the 12 and 26-day exponential moving averages. That's a lot to worry about. So just this represents the difference between two lagging indicators, two moving averages. You smooth that out a little further over 9 days, and that's the red line called the signal line. And very simply, you look at when these cross down and up through one another. And when they cross up through each other, that is a buy signal. When it crosses down, that's a sell signal. And that's the very simple understanding of MACD. So generally speaking, the way that Mr. Apple sort of designed this was, as the market sells off, you see the MACD indicator cross up through the signal line. That happens here in the beginning of January, and that sort of suggests to you that the trend has now turned up. It's not a leading indicator. It's not going to tell you before it happens. It sort of confirms it after we have a bottom. So it is more of a confirmational signal than you would get from something else. And then as the market rolls over, you start to see a sell-off. You then would see the sell signal emerge at the beginning of February. That tells you that the trend has now turned lower. So as you can see, it doesn't really get you in at the bottom or before. It gets you in a little after, and it gets you out a little after the top. And that, again, is by design. It's designed to lag behind the price action and help you understand where things are headed. So if you look really quickly, it tends to do very well in a trending market, right? When the market is trending up and down, has clear movements. In periods where things are a little choppier, a little more volatile, a little more sideways, the chart of the S&P 500, think back to 2015, for example, right, which was a year of a lot of volatility, sort of choppy movement. The MACD indicator was a lot less helpful because of that, right? Because it was at one of those more choppy, less volatile stretches. So how would you use it here in this example with United Healthcare, UNH? So essentially what it's telling you here is the fourth week in September, we roll over, we get a sell signal here a day into that sell-off. That's telling you the trend is now down until we get a buy signal of the MACD line crossing back up through the signal line. It tells you to hold off and wait to get some sort of confirmation that the trend is moving back higher. We haven't quite gotten it yet. Now, the other information you see on here is the series of blue bars, the histogram, which essentially just shows you the difference between these two lines, the MACD line and the signal line. This can be used as sort of a leading indicator. And what I mean is this: as the market sells off, you can see the histogram is going down as these lines are spreading out. That's telling you that the downside is accelerating, right? You can see that the histogram starts to go back up. That's telling you the momentum of the down move is slowing down, and it might be an early warning signal that things are potentially reversing. The confirmation is what you get from the buy signal later when they cross each other. So what you look at, what we see right now is as the United Healthcare has rallied a little bit, you can see that the histogram has started to slope back upwards. That's sort of your early warning that we could be getting a sell signal. Might put it on your watch list. The buy signal that you would get from the MACD line would sort of confirm it. So the MACD histogram can be a little more of a leading indicator, kind of an oscillator based on this methodology. You'll find it lines up sometimes with something like the RSI indicator, measure of momentum, because that's really what it's doing. It's measuring the momentum or the rate of the trend as opposed to the actual trend following tool that you laid out there. Now, a question we've gotten already, and I just want to put it on there. How does that compare to the PPO indicator? I'm going to pop that on here as well, the percent price oscillator. And the answer is they are almost identical, is the quick answer. So a lot of times you can use those interchangeably. And if you look at the two here, the MACD line here, the PPO indicator, you can see they look identical, right? Because they're essentially derived from the same exact data. The numbers over here on the right are going to be a little different because the MACD line is based on price values. The PPO, percent price oscillator, is based on percents, right? So over a short period of time, they're going to look exactly the same and you will have the same exact signals. And the only thing that will be different are the values over at the right. If you're screening using this type of indicator, you always want to use the PPO instead because it's a lot more consistent across stocks, right? So if you look at a lot of different equities, you will find that the signals are very similar across stocks that way. Now, if you look at what happens when I make this a weekly chart, now you can see why the two indicators are actually different. Because when we're bringing in a lot more data, last 7 years of United Healthcare, the percent movements have actually been different. They've not been consistent over this entire period. So the further we get to the left, the further that these indicators will differ. The signals will be pretty much the same or very, very close, but just the movement of the indicator, right? Just the contours of them will be very different. And what happens with the MACD indicator, with anything that's sort of rallied like this, is the left side of the chart earlier in the history will be very muted just because the current movements have such wider price ranges. The PPO indicator kind of standardizes that. So if you're looking at longer term charts, especially weekly charts, you definitely want to be using the PPO indicator if you could. Only for a longer term analysis, it'll make a lot more sense and it won't be pegged as much to the price movements. Now, one place where I use this indicator very often, as I find it, here we go. I have a market trend look that I've followed for years, and it essentially is based on the 21 and 34 exponential averages. And what we can see here is the PPO based on the 12 and 26 and 9, sort of the traditional measure. And then here, I'm actually showing the difference between these two moving averages as a PPO line. And as long as that line is above 0, the longer term secular trend is still positive. When it gets below zero, that would tell you that the secular trend is more negative. So it most recently turned negative going into the market bottom in December, turned back positive here in February, and then since then has remained very positive. So these are great ways that you can take a long-term look, especially looking at weekly data with something like the MACD and the PPO indicators. Really good for a long-term look. And again, it's all about the crossing of the two lines. If you're not super familiar with this sort of thing, there are two things I would suggest you. Number one, go to Chart School on StockCharts.com, and if you search for MACD, you'll find articles that sort of back this up. Greg Schnell, who spoke yesterday about indicators, he uses weekly PPOs often in his work. So if you're not familiar with his show, check it out on StockCharts TV or check it out on our YouTube channel, and you'll find some good examples of how to incorporate that into what you're doing. We're going to take a quick commercial break. We'll come back to wrap up the week. Earlier in the week, I found so often that people get caught up in the short-term fluctuations, right? The short-term movements, what's working today, what isn't working today, all the news flow, the earnings. And this is a really good time to sort of take a step back heading into the weekend and just reflect on where we're at and where we're headed and get some things in mind. So when you come back on Monday, you've got a good idea, a good set of tools in front of you. So to wrap the week, two things that I'd like to do today. Number one, I have a chart list called the Mindful Investor Live chart list. We're going to walk through all of those very quickly. I found for me, this is a list of charts that I've built up over the years as a way to sort of capture this thinking, this sort of long-term thinking. How are things moving relative to one another? Make sure I understand them, particularly with the equity markets. Then the second thing we're going to do is use the Scooter reports, the Scooter rankings, to look at individual stock movements this week. So just make sure we know what's been moving going into the Friday close and what potentially might be on the hopper for next week. So to start off with, let's start with the big picture trend. This is a chart we finished with just before the commercial break. And again, what I've always asked people is, what's the first chart that you look at every day, or do whatever your routine is? What's the first thing you look at? And you are priming yourself mentally in a very key way. I would not minimize the importance of that. So just so you know, this is the first chart I look at every day, and it is a 5-year weekly chart of the S&P 500, which is really long-term, but it reminds me of the long-term trend. So forget about what I'm seeing, forget about what I'm thinking. This is what the trend is. And everything else I see after that moment is all is all based on this being the long-term trend. And by any measure, the trend has been up. So let's not get too crazy about markets tanking, about the volatility. Overall, that is one little blip within a consistent long-term trend. One thing that's noteworthy here during the last segment on MACD, we talked about the PPO indicator, and the weekly PPO is what I'm showing you here. For me, this tends to capture more the tactical trend. So while this captures the secular sort of long-term trend, this will capture more of the tactical, more of the short-term fluctuations, how the short-term stock market movements are lining up with the long term. And you can see this turned negative going into the beginning of August. And it was based off of that first sell-off after the new closing high sort of triggered that downtrend. And since then, it's leaning more on the weaker side than the stronger side. So if and when we would get a break back higher on that indicator, we have not had that yet, that would tell you to maybe potentially expect some more upside. The next chart, again, a lot of these will look familiar because this is where I've pulled a lot of the 3 and 3 from, again, because I look at them every day and just check on where they're at, think on them. And so this one is looking at the breadth in the S&P by cap tiers. So this is the closing values of the S&P going back. This is the advanced decline line for the S&P 500 for the broader New York Stock Exchange, mid-cap stocks, small cap stocks. These have all turned red over the last week as they've gone below a support level that I laid out based on the peaks that we saw going into the summer months. And so small caps broke first, mid caps followed through, the NYSE has followed through. The only one that is still in a positive configuration is the S&P. So I'm certainly watching to see if we get some downside follow through there. This is a chart of the new highs and new lows on the S&P 500, and this is today's action going up a little bit. We can see that as the market has been in this phase for the last month, there have been less and less new highs. So every time the market has tried to go higher, less and less stocks have been breaking to new 52-week highs. And that is, in my opinion, sort of a telling picture of inherent weakness with individual stocks. You also see some new lows. So as we sold off, the S&P didn't get anywhere near a new 52-week low, but plenty of stocks actually did. And that's what that is reminding us of. The breadth is potentially starting to turn. Another way that we've identified some weakness and breadth is looking at this. This is the percent of S&P stocks above their 50-day moving averages. You can see as the S&P has gone to every peak, there have been less and less stocks. Started out the first time it was over 90%. This last time only about 75, 76%. That, again, that divergence of higher prices but lower breadth in the form of stocks confirming it just means more and more stocks are starting to roll over a little bit, which is an area of concern. Out of all the things I'm probably going to show you today, this is maybe the most concerning if you're on the bullish side, and this is the ratio of offense versus defense in the consumer space. So it's a simple ratio of the S&P, the S&P Consumer Discretionary Index versus the Consumer Staples Index. If this line is going up, offense in the form of discretionary is outperforming. When the line's going down, the more defensive staples are outperforming or discretionary is underperforming. You can see that as the market has rallied this week going into Thursday and Friday, look at how this line has actually continued lower. So consumer staples charts actually look really, really good relative to consumer discretionary. And that is not what you would normally see in a healthy bull market environment. It's more of a bear market configuration. So I had identified this trend line, and if we would break above there, which it looked like we were preparing to do here earlier in the month, we have not done that, and to the contrary, have actually gone away from that, continued this downtrend. So you have lower highs, lower lows, suggesting more defense than offense within consumer. Now, the reason why I can't be pounding the table bullish or bearish or anything for you right now is for every chart like that, I can show you a chart like this one. This is the relative performance of semiconductors versus the S&P. To put simply, this does tend to do well. It tends to go up in a bull market phase, tends to go down in a bear market phase. And so the fact that on a relative basis, semiconductors have been emerging and continuing as leadership is literally more on the bullish side of the ledger, right? It's suggesting that, especially just within the technology space, semiconductors are holding up pretty well. And if you follow the show here, KLIC is one of the semiconductor names that's consistently been at or near the top of the scooter rankings, right? Out of all the large cap universe. So it's telling that that's sort of what we're seeing. I want to go very quickly through a couple other points here. Momentum sold off so deeply at the beginning of the month. Second week in September was absolutely brutal. And I was talking with my friend John Lewis at Dorsey Wright at a conference last month, and we were talking about this. And he reminded me that big drawdowns are part of the momentum trade. Momentum overall works, and you can see that it's recovered very nicely. But you have to be mentally prepared for the market fluctuating and the momentum trade not working. And this is essentially just betting on stocks that are working, which over the long term has been a consistent outperforming factor, but certainly volatile recently, but holding up very nicely going into the weekend. Small cap stocks have continued to underperform. And again, thinking of what to worry about, this is one of those things along with the consumer space. This just isn't the configuration I would want to see if I'm bullish on the long term, because you'd want to see the more speculative small cap stocks emerging. Growth and value are a really interesting one. We had Mark Newton on yesterday. He talked about some long-term views of growth versus value. And his point was one that we've talked about, which was if value does start to emerge, if this line would continue lower going into next week and beyond, that is a very different configuration than most investors are used to. And I think that could be, really concerning for a lot of people, just, preparing themselves for value stocks really starting to work. Last one I want to show you here, and then let's get into some individual names. This is a chart of the U.S. versus the rest of the world, or it's actually the U.S. versus everything. It's the S&P 500, the U.S. benchmark versus all country world, which is 50% US, 50% non-US. So it's sort of the US versus everything you could invest in. And as you can see, the ratio rolled over, sort of going into end of August, beginning of September, has found support right at the 50-day moving average, overall holding in there pretty nicely and going to new relative highs going into the weekend here on Friday's close. So basically, there's this stretch here where it felt like, wow, is the U.S. trade going to start to wear off? Meaning, are you better off looking outside the U.S.? So far, it's actually resolving just fine. It's resolving back to the upside. But again, looking for that ratio to roll over, if we would see that, I think that's something you really want to be aware of. Because I know, especially on the institutional side, people are so used to the U.S. outperforming that when the U.S. would start to underperform, you'll be caught off guard if you don't have international exposure in your portfolio. So this is the line I'd be looking for to try to get some sense there. So that was a sort of a big picture view. And again, that's using the Mindful Investor live chart list. If you've not seen that, or if you want access to it, just shoot me an email. It's the final bar at StockCharts.com, and I'm happy to send you a link to that. Just you can bookmark it on your browser. I'll keep it updated, and you can check those charts. Obviously, save them to your own login. Do whatever you want to them as well. To wrap up the week segment, to continue and sort of give my final thoughts here, I just want to look at the stock level just for 1 minute. And in particular, look at what's been leading the way up here. These are the stocks that are ranked at the top of the list going into Friday's close. And again, a semiconductor stock being number one is pretty key. We talked about home builders yesterday, and Pulte Home Group, Lennar, all popping up on the top 10 list. Also some staple stocks, something like Hershey Foods, which wow, the fact that those names are holding in is pretty attractive. Also, dollar stores coming up here. Financials appearing as well. And so something like Cincinnati Financial Group, again, the scooter rankings are really helpful for focusing in on the names that are really working. So if you've not used those reports before, if you go to the scooter table, the scooter reports, look at the large cap, you can sort it by different things, see what has moved up and down the most during the week, and you'll see what's emerging. Another semiconductor, by the way, Skyworks jumping as well on Apple News today. That was a wrap the week segment. I'd love your feedback on how we sort of went through things from a big picture. But to wrap up today's show, we're going to hit the 3 and 3. This is, again, at the end of every show, we're going to go through 3 charts in 3 minutes and give you the 3 charts that, again, if you have not followed these or if you take nothing away from our conversation, please jot down these 3 charts, recreate them on your login and follow them, because I think these are ones you want to see. So first off, we talked about the MACD indicator, also the PPO indicator today. Again, go to Chart School if you're not as familiar with those and you want a little refresher. But overall, this is one of the charts that I look at all the time. This is the weekly PPO on the S&P 500. As we mentioned earlier in the market recap, the fact that this has rolled over gave a sell signal at the end of end of July, and has remained negative. All that tells you is this tactical period is still on the downside. It's more down than up based on the direction of the trend. So to be more bullish, to be more positive, even with the rally today, I would want to see an upswing in that indicator. I'd want to see a buy signal there that would tell me, that I could be more comfortable expecting further upside on the S&P. We have not seen it yet. The second chart on the 3 and 3 today is the relative performance of semiconductors versus the S&P 500. And again, these ratio charts are so helpful for just understanding relative movements, for understanding big picture, what's working and what isn't, and where are institutions, where's the big money flowing, the smart money. And what this is showing you as this ratio has gone higher is that institutions are rotating or have continued to up their bets on the semiconductor space. So if you didn't know that the market was so volatile, market was, teasing, new swing lows and testing support, this line just keeps going up, which tells you that overall the strength is just fine, right? That semiconductors are doing well. And again, that is more of a bull market configuration. Again, if there are other things that didn't look so, so questionable, I'd probably feel a lot better about stocks. But this is one thing that I would certainly check on the positive camp. If we break above the trend line, most importantly, make new relative highs for the year, I think that would give an all clear of sorts, telling you to feel more comfortable going into year end. The final chart on the 3 and 3 is just a chart of the S&P utilities sector, the XLU ETF. I posted this on Twitter earlier, had a number of people write back about, boy, does that feel negative to you? It feels more positive to me, and I can't argue with that. The fact that this is a very defensive sector, I think, is what's most concerning, right? This is a pretty boring, it is not sexy, it's sort of, low and slow, but high dividend payers, pretty conservative, but pretty consistent. And just the fact that this chart has gone from bottom left to up and to the right, outperforming, making new relative highs again this week. I mean, that's the type of chart. If your portfolio looked like that chart, how bad would you feel? Like, I'd feel pretty good about that, right? So watching utilities and seeing if we continue to see leadership in utilities, I think, is one of the themes that I'll be looking at going into next week and beyond, and especially into year end. Boy, that is a wrap for this first week of the final bar. I want to thank you so much for joining us this first week. Really excited to continue on next week and beyond. We've got a full slate of guests going into next week. You can email us anytime, thefinalbar@stockcharts.com or @finalbarsctv on Twitter. Have a great weekend.